Welcome to the Brew. This is not who you expected. Our Master Chief Lex is out, but he'll be back soon. But we've got some exciting stuff with Paulina for this Friday. We're going to look at New York Stock Exchange extending hours to 22 hours, which is a big deal. We're going to start to see technology shift everything that we've known to be tried and true over a long period. So we're going to start to adapt. And then we've got rent and mortgages are looking pretty equal. So she's going to review moves to do there. And then we're going to revisit Amazon, Walmart, and Costco. So we touched base a little bit with that last week, and we're going to revisit and why you should own some of these. No advice, but she's going to give you some golden tips. So stay tuned. Hey, Paulina.
Hey, Molly.
So just to get the excuses away, yes, it's for you, Lex. That's for you. Yeah, so we have some exciting stuff. I'm really interested in this first topic. So New York Stock Exchange, we're seeing technology kind of sweep. We saw this initially with Jay Clayton and Sam Bankman-Fried were in discussions. Sam Bankman-Fried was trying to look into direct clearing. Obviously, what happened, it was denied. Was that a setup to squash that first example? We don't know, but take a look at that. But what do you see on your end on this?
Yeah, so I thought this was a really important piece of news, the NYC extending or planning to extend the trading window so people can trade outside of the normal hours, which are 9:30 a.m. to 4 p.m. Eastern. So there has been a growing interest from investors and traders to capitalize on the off hours, particularly through trading apps like Robinhood and crypto apps like Coinbase. So there are pros and cons to this. But overall, it seems like it's encouraging because now the everyday retail investor and trader now has an opportunity to trade, outside of the normal hours, just like some of the big guys on the street do. So that's the first piece of news right there. And of course, there are implications for investors. And
then we've seen, we're seeing T+1. So settlement in a day with some of these exchanges like SIBO. That I think when we start to look at, why wouldn't that happen? It's a digital world. Back in the 70s, they used to have, and I wish Lex were here on this because he would tell us, because he's a market maker and he was on the floor, but they would have pieces of paper and you'd have to do a lot of these calculations in your head on the fly with yelling and shouting. So as we start to expand these trading tools, we start to leverage some of that edge that that assist us with, and that begins to actually lower volatility. In some cases, of course, we see things like Volmageddon that occur, but it's a changing landscape. So I think what we're going to do in the future is a really important topic to explain how the system currently works, and then what changes are ahead of us in the frontiers of technology, and what's going to stay the same in 10 years and what will change in 10 years. So definitely interesting there. Okay, this is a big one for people. Mortgages and rent are reaching parity. That's surprising because I always think that with rising housing costs, we see, and high interest rates, it's tougher to buy a house. And so I would think that, home purchases and mortgages kind of take a dive while rents increase. And so we see, but you're seeing a parity. So which means they're equal. Parity means equal. So tell us more.
Yeah. So far in 2024, renting remains more cost effective than buying a home across the US and its different metro areas. And that's because monthly mortgage payments, they've been hurt by the rising interest rates. Of course, those have come down recently, and it is a lagging effect. So even though they have come down since the Fed cut massively in September, it takes a few months even beyond that for that to reach different areas of the economy. One reason for this, for the parity between, renting and versus, mortgages kind of being equal, is because home prices have just reached at such a high price. And that, as a result, that increases the overall mortgage payment. So just to kind of give you an idea of the different averages of renting versus paying a mortgage, the national average for the 30-year mortgages is roughly, what do I have here? I have a note here. It's $2,703 versus the monthly average rent in the US is $1,979. So that's a 36.6% difference. Again, making it more cost effective to rent versus buy a home. And we're thinking of buying a home as the American dream, and it seems like that quote unquote American dream is not as close as it once used to be. And another reason I'll highlight for the high prices, of course, is the house inventory shortage. The way home prices work is through supply and demand. And given that there's low housing inventory, that's pushing the existing home prices higher. So that's making it more challenging for potential home buyers to enter the market. And as a result, what's the point of this news? Well, I think that there could be an opportunity for investors who are interested in investing in multifamily real estate, because a lot of would-be first-time home buyers could be choosing to go with a multifamily property to rent until maybe the price of housing eventually comes down. So there could be a pocket or pockets of opportunity depending on your location, of course. This range is depending on where in the US you live. Some multifamily markets may not be doing as well as other areas of the US. So there's a lot of caveats here, but more broadly, it seems like multifamily real estate could be an opportunity given that it's more cost effective, and potential home buyers could choose to go the renting route.
Got it. Okay. So this is really interesting. So as far as diversifying your portfolio, you can do things like open a whole life insurance policy. And if you're healthy and you're young, and then you take a loan out. So you borrow against yourself, essentially becoming your own banker. Go buy one of these investment properties, do it with a buddy. And then you can then pull the equity out of those homes to then go to your next one, and next one, and next one. So there's all sorts of fun tricks. Obviously, that's reductive. So if you're interested in more of a detail, we can get an expert on here on how to do that. But obviously, sheltering those in legal environments that protect you. But I think also, obviously we see on the streets of discontent on these younger generations. Renting is absolutely more cost effective because something breaks, you just call the landlord. So there is, especially with that, you can rent some of these properties out. It's a great investment opportunity. So how do you think this might change with the election? We did an interview with this incredible real estate tycoon. So his name is Bill. Check it out. We'll put the link down below. But he states that there is general optimism in property valuation. So if you own a home already, you can possibly take the equity out of that to invest in commercial real estate or multifamily real estate. What do you think is going to happen with the new governance?
Yeah, I think that's an important question, and one that pretty much investors in all different sectors are asking with this new administration coming in. How is this going to be impacting the real estate market specifically? And I think that the place where we can hone in on is interest rates and the Federal Reserve. And it seems like they're using interest rates as their main tool to adjust to the changing environment. And So I think that there might be maybe one more cut coming. And as a result, that is going to impact the interest rates, the long-term interest rates, of course, which therefore impacts your mortgage payment. But again, I think it's going to be a lagging indicator. So even though it happens, the Fed is going to meet soon, and they're going to make a decision for December. Whatever that decision is going to be, it's going to take a number of months, maybe like 6 months, in order for the economy to feel that impact. So, and that's the beauty of real estate. So if you want to, have a long-term diversified portfolio and you want real estate to be in there, it could be a good chance to capitalize. Now, given that the environment of a limited housing supply is still going to be out there. So I think for real estate investors, understanding the macro is going to be key to forming your investing strategy within real estate, because the limited new housing supply is going to impact the existing valuations and prices of the properties.
I think people are, that's really interesting. I think people are getting smarter too. I think they're really actually moving for tax purposes. So, which states don't have, aren't going to tax you to death. And also, which, people are actually lifting up their families, and, a great exodus, especially out of California, where I am. We see a lot of people going to Austin and Florida. And so I think another thing to consider also is the conversion. There are conversion rates. There are currency conversion rates across states. So we think of the United States as just United States, as the dollar is all the same. But, buying something in California or New York is much different than buying something in Iowa or Nebraska. Mm-hmm. So if you can't get in, you don't have to get in right on your front doorstep. You can actually travel, take a road trip, and look around. I think it is, people are really starting to realize that with inflation, they have to have some sort of alternative side hustle. And real estate does, one thing they're not making any more of is land. And so I think real estate is really, looks great on your balance sheet. And I think we're going to see millennials, and despite what people say, I think those guys are incredible, really savvy. I mean, I think they are grown up on the fact that we may not have Social Security, and they're grown up on the fact that you're not going to do a life event at a company. And so they try to find certain way, and they have all these apps. So they're just born into this new environment. And so I think they'll probably team up with their buddies, and which equates to a higher demand for some of these properties as they start to get older. And it'll be an interesting landscape. But moving on, let's go look at the behemoths that you wanted to touch base on. So in any order you want, go for it.
Yeah, so last week we talked about the mega retailers and how their influence in the retail market is just getting massive and continuing to grow, and how they're getting the more market share of increasing sales. And those three are Walmart, Amazon, and Costco. And I think that there might be different reasons for owning each, even though they're dominating the same industry. So first is Costco. And what every Costco investor probably knows way too well is that it's an expensive stock. So the reason why it's expensive, and why many analysts argue that the premium of owning Costco is justified, is because it has really strong cash flows. And when a company has strong and recurring cash flows, that's a really good indicator for the strength of the fundamentals and its balance sheet. But it also offers unmatched value that no other retail can replicate. Costco has a really great business model that really no other retailer out there has. It has a really strong relationship with all of its suppliers, which is why it can provide its merchandise at a pretty cheap value. So there's just so many moats that Costco has that other retailers are just not able to replicate. And that's why, I think Costco might be a good long-term holder, as kind of like in an interesting way Apple is. I'm not comparing Costco to Apple, given that they're two totally different companies, but I feel like the mindset of investing in Costco would be similar to the mindset of investing in Apple for the retail sector.
Okay, got it. So you're saying, this is a good hedge, and if you're just purely tech and purely Apple, throw yourself into Costco too. But so here's a trick. So there's a whole liquidation business. So you can kind of see, you can walk through the aisles and see who Costco, this is sort of off topic, who's Costco selling? So who's liquidating through Costco and some of these, call it, we'll stick to these with some of the main liquidators, and there's a mountain of them. If you walk through Costco and you see Quicksilver, and this is my experience because I used to work there, they were a very brand loyal company, and they were starting to liquidate through Costco. That's a sign that you want to look at their balance sheet, because if a company is doing incredible, you're not going to see Rolex, liquidating through Costco. You're not going to see certain companies there that need to be there. Of course, you're going to see, some of the tech companies that I think will touch base. We'll make sure that they're distributing everywhere, but kind of a good trick as far as brand loyal, more niche companies. You can kind of get a sneak peek before it even hits their balance sheet of some of their plans. Okay, go for the next one. And by the way, some of those competitors, I do like Costco, and let's just bring that Lex, being the wine connoisseur that he is, has an excellent selection, and I'm going to give Costco thumbs up as far as the fundamentals and the user experience. And I think they're probably going to just start to automate more supply chain as well as checking out. And we already see that now. So continue on the next one.
Yeah. Okay. So the next one is Amazon. And this one is a little bit more tricky because there are like 5 businesses within one with this company. Amazon, of course, is very multifaceted. It has an e-commerce platform, a cloud business, an advertising business, streaming, grocery. I can go on and on. So there are probably like 5 other units that I didn't mention, but actually Amazon, if you look at the stock, it has been pressured recently. And I think part of the reason of that is because it invests so much in all these different verticals that it has, and new ones that it's expanding into, especially AI. And these ventures, they may take some time to contribute to the bottom line. So as it relates to retail, Amazon obviously has a premier e-commerce platform that consumers are going to buy essentials increasingly. Like, we might think of Amazon as the prime destination to buy your Christmas presents, or buy pretty much anything. But what's interesting, over the past few quarters, people are increasing their purchases of essentials. So like toothbrush, shaving cream, Band-Aids, and so forth. And that is actually putting pressure on the company's margins, which means they're making less profits. And I think the combination of that, lower profits in the e-commerce segment, as well as increased investments in some of the high growth areas that might not be returning as much as it could be in the future, that is why its stock is pressured right now. But that's not a reason to not own Amazon, of course, because it's a Mag 7. It's one of the companies that has been driving the overall market this year. So I think investors might want to be patient before thinking about maybe selling Amazon stock because of the pressures that it's experiencing.
Yeah, and I always like to look at AWS, when you're talking about Amazon. They have had a little bit of a slow in growth, but I think they power, there's such a consolidation of powering behind some of the tech that we use. You don't really feel that consolidation until something like, CrowdStrike happens and planes get halted and, personal computers go down. So I think it's really important to always keep an eye on that segment of the business as well. And we still see growth, but there has been a stagnation in the last the last few periods. Okay, so next one, final one.
Yes, the final one is Walmart. Obviously, for normal reasons, Walmart is one of the top, if not the top, retailer within the sector, and it has a subscription model for Walmart Plus that is kind of similar to Costco. But what's been driving a lot of Walmart's strength this year has been not only it being able to attract, its regular customers, but its ability to attract the high income cohort. So as you mentioned earlier, with inflation has come down, but it has by no means gone away. Everything is more expensive, and companies like Walmart are able to provide more value to customers. And that means even maybe somebody in the higher income cohort is going to go to Walmart if they can save a buck or two. So the fact that Walmart has been showing value to different types of income levels is why the company has been performing well against its competitors, and why it's able to attract more of the wallet share of these different consumers across the income spectrum.
Okay, so yes on all three. You're bullish on all three of those. No advice here, but just you personally.
I would say that if you're an investor in these three companies, it's an exciting investment, because the fundamentals of the companies are strong. And obviously there are risks with every type of investment, but I just think that they've been consistently performing well. And it's important to understand why you're investing in these companies, and if your thesis changes in any way, obviously you can act accordingly. But I think from a fundamental perspective, these companies are pretty solid.
All right, we'll keep an eye out. Thank you, Paulina. Enjoy your weekend, and write in the comments if you want us to expand on any of these topics. Thanks, Paulina. You always bring something great to the table. And by the way, you are not feeling well and you still showed up. So round of applause. Thank you, Paulina. All right, we'll see you next Friday. You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.